Hi everyone, thanks for joining us today for our portfolio construction webinar. This is our series designed to help you discover new investment opportunities and see wealth differently. I'm Jo from the marketing team at NetWealth, and joining me today is our technical services consultant, Nigel Smith. Before I hand over to Nigel, I'll run through some quick housekeeping. If you're a financial advisor, you'll receive 1 CPD point for this webinar. To receive the point, you'll need to be online for at least 30 minutes. You'll then receive the CPD details within the week. This webinar is being recorded, so everyone will receive a copy of the slides and session via the email within the week. If you'd like to ask questions, you can do so via the question tab to the right of your screen. Please note though that due to the nature of this topic, we're unable to answer any questions based on your personal situation. And please be aware that the information today is general advice only and is not intended to be professional financial advice. For those of you who don't know NetWealth, we're an ASX listed company nearing our 20th year, and our purpose is to help Australians see wealth differently and discover a brighter future. We provide investors with a range of investment and super solutions via our platform. Investors can manage their super and investments using our portfolio tools, access a range of reports and online charts, and stay up to date with changes in the market by accessing live prices and charts on our individual stocks. Our platform also supports financial advisors to help manage their clients' investments and super. I now have the pleasure of introducing Nigel. Nigel has been with us for almost 12 years, providing technical and strategic information for advisors, accountants, and investors. He specialises in SMSFs and superannuation, pension planning, contribution management, Centrelink, and estate planning. He also has a Bachelor of Commerce from Melbourne University and certificates from the Securities Institute, the Australian Stock Exchange, and the Securities and Derivatives Industry Association. I'll now hand over to Nigel.
Thanks for that, Jo, and welcome to everybody. I think I'd just like to emphasise the warning on the general advice which Jo gave. Hopefully today's session will cause you to think about and to question some of the existing structures either that you're using or perhaps that your clients are using. And if after considering those things you feel that the structures that you have in place are appropriate, that's terrific. But if you think that possibly some red flags are being raised and you may need to consider a change to this, then please make sure that you get some professional advice from whoever your professional advisor may be that a financial planner, be that your accountant or lawyer, because obviously a lot of the examples which we'll be using, the case studies that I use, are there to illustrate particular points. And that may or may not necessarily relate to your specific circumstances. In regard to the questions, we've got quite a bit to go through. So if we don't get a chance to answer the questions by the end of the session, then I'll do a bit of a review of them and hopefully I'll be able to answer them by email or something along those lines. So if you have questions, just make sure that we've got your contact details so that we can get those to you. Okay, well, as you can see, that today's topic is self-managed super funds and are they close to their use-by date? Well, obviously this webinar was originally organised assuming that Labor was going to win the election. That, of course, changed with the return of the Libs. So to make this of value, I've tried to change the emphasis a little bit to explore the concept of a use-by date for self-managed super funds. And really what we mean by the use-by date is that point. It's not a dating time, it's not a particular age, it's not a particular dollar amount. It's a point at which the benefits of a self-managed super fund are no longer outweighed by the costs, or if you prefer, the costs no longer are so high that the benefits are no longer as strong as they used to be. So to this extent, these are the main topics that I want to be covering off on, to this end, I've decided to cover the following topics here, and to flesh it out, we have to understand that we have an audience which is a mix of both advisors and direct clients. And by direct clients, what we really mean there are clients who don't have a formal financial advisor per se. They may have an accountant, a lawyer who they deal with, and that's fine, but they don't have a formal financial advisor. So the topics are a mix, which I hope will ensure that both groups get some value for the time spent. So, for example, the post-elections and where we are now, hopefully should be of interest to both groups. The life cycle of a self-managed super fund is probably directed more to the direct clients so that they can understand the concepts which we're talking about. The tips and traps for self-managed super funds is again for both advisors and direct clients. These particular traps I want to talk about do apply to both. They're not just a danger for self-managed super funds. They can be a danger to advisors who are providing advice. But as you'll see, I tend to feel that the self-managed super funds are at greater risk of falling into these traps. And that's why I think it's important to highlight them. I should probably declare here now that I actually have my own self-managed super fund, so it's not that I don't like them or anything along those lines, but it is just that there tend to be more practical problems with the open to the self-managed super funds. Then we'll have a quick look at the retail platform versus the self-managed super fund. Again, this is aimed primarily at the direct clients in order to provide them with a bit of a background about which to make better decisions. We'll have a look at some estate planning disasters to avoid, because by far the greatest number of problems that seem to arise is when it comes to estate planning and dealing with death benefits. And again, what I've found over time is that self-managed super funds tend to be more open to these problems than do the retail platforms. And at the end, I guess it's a little bit of a checklist, if you like, a number of questions or a number of circumstances that you can go down and sort of say, yeah, I can see that maybe I should be looking at a retail platform, or conversely, no, definitely self-managed super fund is the way that I'm going to go. So our key takeouts for this particular session are listed up here. As I say, look, this is not a self-managed super fund bashing seminar. As I say, I have my own self-managed super fund. I've been dealing with self-managed super funds both at an actuarial level and at an investment level, at a structure level, for well over 20 years now. I do understand that they have a very important role to play and a very important place in many people's portfolios. To say that they don't would be ridiculous, but they can have a use-by date, and this is an observation which is based on 10 or more years of questions and problems that have crossed our desk. And while there are circumstances where the self-managed super funds are really the only viable option, these circumstances are becoming fewer, and this really becomes a matter of simple fact. For example, if you want to use real property, you're going to be in a self-managed super fund. Tend not to. In fact, I can't think of a single retail fund that will allow you to hold real. So if you've got real property, business real property, things like that, that is circumstances where you can only use a self-managed super fund. But all those options are becoming less viable, not less viable, less flexible, if you like, getting more regulation around them, and are probably the opportunities are becoming fewer. Everything changes. The only thing that's certain in this society is change. So through advances in technology, competitive cost structures, more modern retail super funds are really becoming more and more a realistic alternative to many self-managed super funds. I guess the key takeaway here really is that I would like, at the end of the session, for people to acknowledge that retail platforms are becoming a much more viable alternative to self-managed super funds, even if you don't want to act on it now. So maybe that is still not suitable for you now, but you need to get away from the old train of thought that says, oh, I've got more than 200,000, therefore a self-managed super fund is much better for me, and acknowledge that the times are changing. When it comes to the traps and things, I just need you to be aware of them, because if you get it wrong, there's some horrible penalties and some horrible costs involved. But the comparison between the two is simply trying to put things into perspective so that people have proper decision-making paradigm. And then the estate planning disasters are things which should affect all of us, particularly when you put this against the background of the life cycle of a self-managed super fund, where obviously as we get older, these estate planning issues become more and more important. Okay, so let's have a look-see at what Skymo Miracle win did. I mean, as he said at the time of the election, on the election night, he believes in miracles. Well, his miracle win means that we can all breathe easy now, doesn't it? We're all safe at last. The excess franking credits are going to remain refundable to us. Our self-managed super funds and other lower tax-paying people and entities are all happy again. That seemed to be the main focus, I think, of nearly all the run-up to the election. There were these other four sections which in many ways I thought were just as important, and that is, the continuation of the limited recourse borrowing arrangements, so that now remains a viable strategy as well. Your first home super saver strategies remain ongoing, and if you as an advisor or you as a member think, oh, that's only a minor thing, we have some really strong strategies around first home super saver where you can use it to help your children or even help yourselves, depending on what your circumstances are. The two big ones, the CGT discounts is going to remain unchanged at 50%, and the negative gearing availability remains unchanged. It's not going to only be limited to new properties. And I thought those last two were particularly important there. I mean, the other thing that we need to realise here is that we're saying, oh, we're safe at last. And I don't want to be a scaremonger or anything along those lines, but I would say, do remember the GST. And as you can see up there from that timeline, it goes right back to the 1970s. And I'd probably draw attention mainly to 1995, where John Howard got up there and pledged, never, ever will we have a GST. Well, one would have thought, having said that, is probably well and truly dead. Well, guess what? 1998, Howard resurrects the GST in an election, and he just won that election. If you go cast your minds back, it was a 49% win. He had to form a minority government. And 2 years after that, he comes out and says, I have a mandate to begin a GST. Really? Well, miraculously, as a miracle, GST rose from the dead. So we should, when we're looking at these changes, when we're looking at politicians, when we're looking into the future, and that's what financial planning is really all about, it's about looking to the future. What's really changed? How does this impact? How does the past impact on this? What should we really be believing? The ALP proposals seem to be almost the last straw. They were like the last straw breaking the camel's back. And in the lead up to the election, we saw a lot of evidence of self-managed super funds reevaluating the true value of their funds, looking at retail super platforms as an alternative. And this was probably really a bit more of a knee-jerk reaction, or it was a case of what they call these days FOMO, fear of missing out, of not being able to get their franking credits. And those sort of knee-jerk type reactions are never a good basis to be making decisions. And both Keith and I were on record for a number of times saying, look guys, this is only a proposal. They've got to get into government first, and once they get into government, they've actually got to get it through Parliament. So, do be aware that this is really only a proposal. And as we can see, that never really happened. But we did see a number of advisors, both pre the election and even in the years before that, go through the following process, which we'll be going through today, and the analysis. And many of them actually did close down numerous self-managed super funds simply on the basis that they've got to this use by date. There's a strong case to say that the benefits no longer outweigh the costs of going ahead on it. And if you think about it, as we're moving forward with the Liberals back in power, if you think about what people were doing and all the questions that were being asked, I mean, I did a seminar in Tasmania, and the whole question was about franking credits and self-managed super funds and all that. And if the only reason that you had your self-managed super fund was for the franking credits, and that, you can get those franking credits from a platform, and if this was sufficient reason to change, in other words, I might lose it on my self-managed super fund, I'm going to change the platform so I can get it, and that's your driving force, then I would say, what's changed? you can still get the franking credits from the super platform. Obviously, you're not using all the other benefits that come from the self-managed super funds. You're not using the real property, not using the LRBAs, you're not using the collectibles and all those other benefits where a self-managed super fund really comes into play. Because if you were, you wouldn't have been re-evaluating the situation in a pre-Labor environment. So again, what we really want to get out of the seminar is to have you to ask the questions and to really evaluate whether you're getting the true value out of your self-managed super fund, and if indeed maybe there's another alternative. So the other thing that I think we've seen change is the realisation that retail platforms have changed dramatically in recent years and are now can be a realistic alternative. And there's always been these sort of hurdles about, you know, the cost structures of the retail platforms versus self-managed super funds. And these are fairly common hurdles that have been around for a long time. And look, they're still there to a certain extent, but they are diminishing. Those hurdles are getting lower. And these are the sort of things that I really want people to realise. So is this still the case? Well, as you gather from what I've said, probably I don't think it is. There's certainly not the same immediate call to action. If Labor had got in, yes, there was an immediate call to action regarding the franking credits. We don't have that immediate call to action now, there's no doubt about that. But if you took the time to think about it, then don't waste that time. The key issue here is to think about these issues and to evaluate them in a logical way. Is the threat still likely? Not immediately. But governments are always seeking new revenue. And as we saw the GST, I would say, you know, is the genie out of the bottle? Maybe, maybe not. Something to bear in mind. Are self-managed super funds still suitable to certain clients? Of course they are. Absolutely, no doubt about that. So if we have a look at what I call the life cycle of a self-managed super fund, you can see in this table, if you read through the table, you can see that it's pretty obvious, really. When we're dealing with people who are just starting their in their working career, maybe all they're getting is SG, you know, as they take up their first job and things like that. No way you're going to be using self-managed super funds, or seriously doubt it anyway. You've got simple savings into accumulation, probably lower balances. Retail super platform was the way. 30s to 40s, again, these are just my guesses on personal experience and things like that. You've got mortgages, particularly in this day and age. We've got children, you've got school fees, possibly one salary because of the family situation. Many people are really in survival mode. Get around to super at a later date. We've got lower balances, but we're growing. Again, you'd be struggling to really be able to use self-managed super funds to their full basis and extent there. So again, your retail super platform is probably not a bad idea. 40 to 60, again, that might be 35 to 65, but you get the idea. This is the stage now where people are really starting to think about driving their wealth creation strategies. This is where their businesses are up and running. If you're a self-employed person, you might have your own factory, your own workshop, your own office, your own surgery, whatever it happens to be. You might start to now have some cash flow surpluses. You're going to start to ramp up your salary sacrifice. You're going to ramp up your active investing. You might want to use your limited recourse borrowing arrangements. You might want to integrate business real property strategies and things like that. This is the time when your self-managed super funds really start to come into play. But again, I would emphasise really only if you're going to be using these specialised strategies. So you've got a reasonable balance to start, need for sophisticated strategies. Self-managed super funds are looking pretty good. 60s to 70s, early to mid-retirement years, that's all being pushed out all the time again. We're now starting to look at transition to retirement living off the super, lower risk stable incomes need. Maybe you've got middle-aged children who you might want to think about joining the super fund. That could be another whole topic, I've got to tell you. Okay, well, your self-managed super funds are still okay. They're still going to work really well. And obviously, you know, if you've got property in there, and you've got business real properties strategies integrated with your personal finances, this is where they really come into play still. But responsibility and admin versus advantages is starting to raise its head. Kids might join, maybe probably not a really good idea. Retail super fund platforms are starting to look better, starting to come back into their own, because you're probably not going to have the same emphasis, the same need for all those specialised investments and specialised investment strategies. 70 plus, late retirement, your spending patterns are lower, possible health issues, and obviously we're talking here about your dementias and Alzheimer's and things like that. Sorry to bring it up, but I've got enough grey hairs to know that this is going to be an issue to think about. We're moving now to long-term hold type strategies. We're now starting to consider estate planning issues and all of those sort of things. When you look at it logically, I hope what you'll probably have to hope what you'll agree with anyway is that the self-managed super funds start to offer nowhere near as much value versus the retail super platform. And the retail super platform gives you the benefits of not having any of the admin or trustee issues. Still got plenty of investment choice, and as I say, all the cost structures and things are starting to come down. Does that mean at that age you rush out and wind it up? No, of course not. It depends on where your circumstances are. But you should at least acknowledge that the way you're using your superannuation, the strategies and the investments that you are using are starting to change. And that should cause you to question whether the structure that you're using for them is still the best one and the most appropriate one for those circumstances. Then, of course, we come to death, horrible topic to talk about, but there is nothing more certain than death, and taxes, of course. Surviving spouse to take over, but do they have the wish, the skills, or the knowledge? You would have no idea how many times we come across a situation where it is only the one spouse who has a real interest in super, real interest in the investment, and the other spouse does not. This is where we get the danger period, because if the spouse with the real interest dies, leaves the surviving spouse with a self-managed super fund that they have no skills in, no interest in, and no ability to manage, that becomes a problem. So when it comes to your estate planning, what you want to do really is maximize the balance to the beneficiaries and to the adult children, but almost as importantly, you want to minimize the potential for conflict. You want to ease the management burdens over this particular time. And again, this is where, again, maybe your retail super wrap starts to come back into play. Could you bring adult children into running? Yes, you could. This day and age, with blended families and big age differences between children, let me tell you that there's probably a greater chance of disastrous results coming out of that than there is any real benefits. But again, you know, it depends on the individual circumstances. So our general proposition really is that, you know, self-managed super funds are good at certain life stages. There's no wrong or right answers. And from a company perspective, we deal with as many self-managed super funds. We have a very, very large proportion of our investment wrap dedicated to self-managed super funds. So this is not a manager driven response. It really is trying to get you to think about the structures that you are using and how they are changing over time. So SMFs are good for specialised investments. There's no doubt about that. Real property, business real property, limited recourse borrowing arrangements, the LRBAs, collectibles, illiquid investments, and cure-ops. All of these are the circumstances where you really do need to be using a self-managed super fund. By cure-ops, what we mean, obviously, is it's the transfers from the UK. So UK transfers used to be able to come out into retail super funds. The UK changed their laws. There's not a single major retail platform in Australia that can accept a UK transfer without insisting on some fairly major tax penalties. Just had a quick question to explain what business real property and limited recourse borrowing arrangements are. Business real property is a strategy, we won't be going into it an awful lot, where a self-managed super fund can actually acquire and own a factory, surgery, shop, anything other than a residential property that is used in the business of the member. So you can actually use your self-managed super fund, if you like, to buy the property, and then you effectively pay the rent to your own self-managed super fund. That has a lot of implications for, you know, releasing liquidity from your super fund, getting it back into your own hands, and there's a whole range of strategies there, and it allows you to integrate, if you like, your business plans also with your personal financial planning requirements. Can only be done in a self-managed super fund. That's not law. It simply means retail funds are not in the position to be able to offer that as a potential strategy. So it comes down to the self-managed super funds. Limited recourse borrowing arrangements are highly specialised arrangements that allow trustees to borrow money in order to purchase certain assets. Normally, again, real property, but it can also be used to purchase a group of similar shares, like all BHP shares or all CBA shares or something along those lines. Under virtually in any other circumstances, super funds are not allowed to borrow. It is only under these limited recourse borrowing arrangements. And again, self-managed super funds are really the correct vehicle, the only vehicle that you can really structure these through, because a retail fund that's trustee, the fact that it's offered to a very wide range of people means that it's not a practical alternative to offer. Your collectibles, of course, are your cars, paintings, coins, anything along those lines. Illiquid investments, by that what we mean is usually unlisted shares, startups, things like that, something that's not listed on the stock exchange, and pure ops have just been through being the UK transfers. So unless you're using one of those particular investments or one of those particular strategies, when you look at all the others, listed investments, managed funds, all your normal sort of investment strategies, retail platform doesn't really have any disadvantage for many people. And if you were to look at the numbers of self-managed super funds that were using LRBA arrangements or real business property arrangements or collectibles or liquid investments, you'll find that it is a very, very small number indeed. Self-managed super funds have far less regulatory, admin and trustee responsibilities. That's an old chestnut, I know, but we'll go over it because it's a very important one. And it also gives clearer and more certain estate planning outcomes. And we'll go into that in a little bit later. What I would say, what I mean by that is self-managed super funds give you a heap of flexibility, but that flexibility does bring with it a certain degree of complexity. Retail super platforms are more rigid, they have more rules, and those rules, those defined processes tend to give a more certain outcome, and those certain outcomes suit most people, not all, but most people. As I said, with specialisation comes limitations. What I would really say there is, just because you can do it, should you do it? So real property is a great investment. It's the greatest loved property of most Australians, but it's really illiquid. It has a very long cycle. It tends to be high value within the portfolio, and it's very lumpy. So, you know, you might have a portfolio, you might have a self-managed super fund with $1 million in it, $750,000 might be the property, leaving just $250,000 of other assets. Sometimes it's a lot higher than that. This is what I mean by a vast majority of the fund is then illiquid. You've got a single high value investment, lack of diversity, if you want to call it that, and you've got lumpy investments as well. Your limited recourse borrowing arrangements, we'll have a look at those in a bit more detail, but there are a lot more restrictions from when it first started, when it was really popular, has what I would call far less wiggle room now. Your business real property, again, is limited to commercial property only, and it has really tight definitions. For example, the property must be used exclusively for business. So if you're running a farm and you have your residential property on it, or you're running a motel and you're living in one of the units, it starts to raise questions as to whether or not you can actually use this, and you're just going to have to start getting some proper legal advice and proper structures in place, all of which start to cost money, to make sure that you meet all these new rules, or not new rules, but all these very tight rules. Collectibles, again, changed. Gone are the days where you can go and buy a few paintings and hang them on your boardroom wall, or hang them in your room. Now you've got insurance, you've got to have to store them properly. If you have cars, and I had one guy who won some super fund that had a number of cars. He had about a 10-page investment strategy, did it all properly, all held down at Shannon's, I think it was. He never ever drove them. It was a true investment. But if you think you're going to be able to buy a car, and I'll just take it out on a Sunday because I've got to turn the engine over and keep it running, not going to work anymore. Illiquid investments, again, time and time again, you know, we have people say, oh, our company's about to list, I've got some shares in here, I'm going to transfer them in specie into my self-managed super fund. No, you're not. Section 66 says you can't acquire assets from a member unless they meet certain criteria, being listed shares, cash, business real property, and a few others. So if you've got an illiquid investment, if you've got an unlisted company that you know is going to go up by 200 or 300%, if you own it, you still can't get it into your self-managed super fund. You've got to get it in there before you own it. And don't think that you can maybe go via salary sacrifice, or you can say, I'll have the employer put the shares in as a bonus, because that's just a device to get around 66, and it's just not going to work. So again, you can do it, but you've got to get the timing right. You've got to understand what the rules are. QROPs, reporting and investment restrictions. If you've got one of those in your self-managed super fund, again, a lot of people don't understand it. For example, one of the things not many people realise is that if you have a QROPs element in your self-managed super fund, you can no longer invest in retail property. That's not an Australian rule, it's a UK rule. And the UK rule applies because you've got that QROPs element in your fund. Now, of course, the trustee has the responsibility to report back to the UK authorities if this happens. Possibly best I don't say any more about that when it comes to a self-managed super fund, and you have to have a trustee that's going to report on itself. But these are still nonetheless problems or rules which you need to be aware of. And so, as I say, again, your self-managed super funds are great at certain stages of life, but as you move through, things change. So one of the biggest queries we always hear looking at some of these tips and traps is understanding, really I say understanding super and understanding investment performance, and this really comes to what super really is. I mean, people see it time and time again, start a self-managed super fund because of poor investment performance. They sort of say, that fund manager never did any good for me. I started a self-managed super fund so I can make my own decisions. Let's not go into why you think you can make a better decision than a professional manager with all their resources all over the place. The point is, super is a tax construct. It's how effectively you use the benefits of super that's more important to the performance. Same investments equals the same performance. You hold Strike It Lucky Oil and No Hope Mining in a self-managed super fund, or fund manager buys it in an industry fund or in a retail fund, loses 50%. It loses 50% in both, whether it's a self-managed super fund or whether it's an industry fund. It's how you use them. Super is a tax construct, and it is one of the best, most efficient, most generous tax constructs that is accessible to just about anybody. So investment performance is not necessarily a really good reason to get out of an industry fund or a retail fund and go into a self-managed super fund. If you think you can do a better job, maybe. The key, or some of the keys to performance, as far as I can see anyway, is really the management decisions and the costs. You need current, comprehensive and timely information to make effective investment decisions. Retail funds tend to be very transparent. They tend to have really good reporting, disciplines around them, really good reports available to help you make decisions. Put that against a self-managed super fund. As I say, I had my own one. I can't go to my accountant and say, oh, can you give me a portfolio update right now? No, I don't. I run mine through an investment wrap. You may run yours through CommSec. You may have some other external provider that provides all that information. I'd say, is there a cost there? If so, you need to take that into account when you're looking at the various values and the comparisons between your retail platforms and your self-managed super funds. And again, self-managed super funds have many associated costs that often get forgotten. We have auditing, that's the obvious one. But we have, as I say, the research and reporting packages. Now, maybe you can get enough information from CommSec. If you have a stockbroker, maybe they provide enough information for you without any cost. I don't know. That's a question that I raise for you to consider. What I do know is that you often see from these online administration providers really cheap admin, provided you use XYZ Bank CMT and you only use listed securities. Anything else, you start to get additional costs. So you need to be aware of those things. Accounting time as well. For a writing of minutes and specialised strategies. Again, e.g., you know, a segregation of assets where you want to separate specific assets to pensions and specific assets to accumulation, your limited recourse borrowing, your transition to retirement pensions and things like this. And again, I draw my own experience here. For the year ending 30 June 17, when we had all those changes, my own personal bill for my self-managed super fund went up by nearly $1,200 because I said, look, this is a decision point. I want to do this, 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 and this. I wrote most of my own minutes. But because the accountant couldn't just do a normal, bland, brick vanilla type thing, administration had started thinking about it, had to start doing other specialised things, the cost started to go up. If I'd been in a retail super fund, I could have done all of those same things. I would not have had any of those particular costs. You might say, then why didn't you? The answer is I've got some real property in my self-managed super fund, so I have no choice but to be in one. Also, the availability of managed models, exchange-traded funds, your specialist fund managers greatly close the investment gaps and options that you have between self-managed super funds and retail funds. I'm going to have to keep moving here because I'm going to be running out of time otherwise. Real property traps. You know, there are two real property traps. And again, these are not just, these tend to relate more to self-managed super funds because this is where you have them. One is for the living and one is for the dead. As a broad statement, what I'd say is big enough, young enough, then fair enough. What do I mean by that? Well, you know, if you've got a $3 million fund and you've got $1 million worth of property in it, you've got good diversification, you've got good cash flows, not a problem in the world. If you've got $1 million fund and it's got a single property in it, you've got what I call these single asset fund problems, as we can see here. Maybe if you're young enough and you've got yourself and your spouse coming in and you've got lots of contributions coming in and you can do salary sacrifice, maybe that's okay. But if you're approaching retirement, if you're approaching the later years where you're not going to have the ability to make long-term contributions, then you start to get these real problems with these real properties in a self-managed super fund. Not all of them, some of them. Again, think about it. Is there enough income to meet the fund's running costs? I get that question more often than you would think. This is particularly where we've got an older member, maybe in their 70s or their 80s, they've got all these costs, coupled with the next point, which is enough income to meet the minimum pension payments. As you get older, the pension payments are going up. And I've seen many, many cases where all the cash has been used, all the liquid assets have been sold, all that's left now is the property. How can we meet the minimum pension requirements? Guess what? There's not a lot of options. You're going to be forced to sell that property. And is that the right time to sell the property? Maybe you have no choice. Divorce and business breakups can often force premature sale. And this can be really major problems where two business partners break up and you know, they've created a self-managed super fund between the two of them in order to put the property in, or they are both members of the same self-managed super fund, because you can have up to 4 members in a fund, can create some major problems. And if you're in that situation, again, you probably need to get some pretty good, strong professional legal advice. You get lumpy asset problems, lack of diversification and performance impacts. Property was going up and up and up. That was great. If you had a single property, single asset fund, it seemed to be going up, you're making contributions, that's really good. What about now? Values come down, maybe you're not getting the same rental income, things have changed. You can't just sell part of your property. This lack of diversification gives you impacts on your performance, it impacts on your ability to change and manage the portfolio over time. Timing, long holding horizons on property versus short-term needs. Again, if you're big enough, young enough, fair enough. But as you're getting older, when you look at the life cycle of a self-managed super fund, these problems start to raise their heads. For the dead, you have even more problems. Well, maybe you don't. If you're dead, do you really care what happens to your survivors? But you should. So it can leave really complex problems for survivors. Getting older equals higher pensions equals greater cash flows. This can lead to cash flow shortages. I see it all the time. It reduces your death choices. It may limit you to only being able to pay a pension. I mean, if you've got somebody if you've got just one property in there you don't want to sell that property, if somebody needs a lump sum, you just can't pay for it. You've just got, the only choice there is to pay a pension. Or it may force a sale at the wrong point of the cycle. When it comes to business real property, where you're dealing with business partners, you have a whole range of other problems, potential problems. Difficult or impossible to pay out with a sale to sale. Business partner dies, leaves the spouse, spouse wants to get hold of the money, got children to educate, things like that, would like the death benefit payout. If you've just got the single property in there, how are you going to achieve that? It may mean that it leaves the deceased partners in the business if they're willing to stay there. Is that something you really want? Or the deceased partner may force the sale to get the benefit cashed. Again, is it the right time of the cycle? If it's the property you're working out of, is that the best course of action? It used to be that you could use cross-insurance to solve this problem. You can't do that anymore. So often the only real solution may be to pay the deceased partners a pension. That's if they're agreeable, and that still leaves them in the equation. So again, these are just some of the issues that you might need to face. Okay, limited recourse borrowing arrangements. Great flexibility, but that flexibility and that wiggle room has been significantly reduced. So what I'd say is remember the good old days, related party loans, 0% interest rates, very high loan to value ratios. You know, you could borrow 90%, 95%. No maximum term to the loan, so you've got a 0 interest rate and a 30-year time frame on it. Interest-only repayments allowed, and no total super balance issues, which have raised their heads since 1 July 2017. The current rules are much more controlling. We have really specific loan conditions for property and also for shares, but related party loans must now be benchmarked, usually benchmarked against what's available on the open market. It's got to be on an arm's length basis. Minimum interest rates is the RBA indicator factor, which equals at the moment about 5.8%. You've got a maximum term for the fixed interest rate, 5 years, and then it must go to variable. Maximum loan term of 15 years, that's even after you've renewed it. Maximum LVR of 70%, must have executed loan agreements and registered mortgages. Again, more costs there, you've got to get all these written. Monthly P&I repayments only, no more interest only. Equities have even stricter conditions. And there's legislation before the Parliament at the moment which is saying that it's very likely that members' total super balance, that is the total amount that they have in superannuation, will be increased by the proportion of the outstanding loan amount where the arrangement started on or after 1 July 18, where they've met a nil cashing restriction, or where there's a loan from the associated party. The impact of that means that your total super balance, which I say is basically the total amount you've got in super, impacts on whether or not you can make non-concessional contributions into super and other contributions into super. So suddenly we're going to have new rules around which could mean that having these arrangements in place is going to start to restrict the amount of money that you can actually get into super. Complexity leads to unintentional problems as well. I mean, a simple example of that was the 0 interest rate. The ATO came out in those days and said, yep, you can have 0 interest rate, it's not a breach. Read the fine print, it said, but this doesn't mean that it may not breach another section of the Tax Act. And they came out about 3 months later and said, oh, by the way, you've got all these problems. And people were scurrying to unwind situations and things like that. We had another situation where the LRBA arrangement was put in place with the best of intentions. The client had unlisted shares, they were going to have a massive increase in value, put in a limited recourse borrowing arrangement, structured the whole lot through on an investment wrap so that they could see where the values were, provide all the reports to the accountant for doing the administration and all of those sort of things. It was all kosher, all professional, all above board. True good arrangement for limited recourse borrowing arrangement, except they forgot to switch off the auto sell. And what that meant was that when the cash levels got low, the system automatically sold some of the shares to replenish the cash so there's enough money there to pay the advisor fees, the accountant fees, and all those sort of things. And of course, with the limited recourse borrowing arrangements, I'm sure you all know this, if you sell a couple of the shares or some of the shares, it's no longer the same asset. You cannot partially sell some of the shares, which meant the whole arrangement went into breach. There's a very long, drawn out, very expensive legal advice to sort that one out and avoid any penalties from the ATO. So again, great use. Used to be fantastic, used to have lots of wiggle room. You don't have that now. The rules are really quite complex. You need to know what you're doing. This is a really big one, and I'm being told to wind it up. Here we go. Death tax trap for the spouse. Now again, this is for both self-managed super funds and for advisors. It's a big one for advisors as well. And it's a new one because it's only been a problem since 1 July 2017. And from that date, once a death benefit, always a death benefit. Now that has some advantages because what it means is it doesn't matter whether you cash it out in 3 months' time or in 6 months' time or in 6 years' time or in 10 years' time. It's always going to be a death benefit. It's always there for the spouse, going to be tax-free. And I'm limiting my comments here just to a spouse situation, okay? That's a huge advantage. The old rules, where you had 3 months, 6 months from date death, 3 months from date of probate, where it could convert and become a member benefit, are not there. So this rule applies even if you've still got a death benefit pension or something along those lines that started 10 years ago and you never rolled it over or never did anything under that old prescribed period. And again, we've had this question come over our desk twice now, I think in the last 2 weeks. So since 1 July 17, once a death benefit, always death benefit. The spouse death benefit can be rolled over, but only to start a death benefit income stream. You cannot leave a death benefit in accumulation. An untaxed element arises where all three of these conditions are met, and all three must be met. There is a death benefit lump sum, it contains an insurance payment, and a tax deduction has been claimed on the premium. If all those three conditions are met, then an untaxed element is calculated based on an ATO formula and is created. A death benefit rollover from one fund to another fund creates a lump sum payment. That triggers one of those three conditions, which means that up to the untaxed cap, which is about 1.5 mil, the receiving fund must deduct 15% tax to convert the untaxed element to a taxed element. So what does this mean? I've got a case study on the next slide. Spouse has, say, $1 million term life policy structured through their insurance. They claim a tax deduction on the premium, which 99.9% of cases will happen. Spouse dies, insurance pays the death benefit to the deceased member's account. Fairly standard sort of scenario. What are the options for the surviving spouse? Take a death benefit lump sum, takes a death income stream from the same fund, rolls over to a new fund to start a death benefit income stream. That can happen whether the spouse wants to continue with the self-managed super fund, or rather doesn't want to continue with the self-managed super fund because it's too complex, they don't have the interest, they don't have the time, they're looking after kids, or whether an advisor recommends to roll over to a better fund, more modern fund, a cheaper fund, or any of these sort of circumstances. So it's a real danger point for both self-managed super funds where one partner has died, and also for advisors, both with retail funds and self-managed super funds, because this is a bit of a summary. So you can see here, Adrian died at 45, only recently, August 18. He had 50,000, 10,000 tax-free component, which means 40,000 was a taxable component, $1 million worth of life's policy. So we've got service date from 2013. How much untaxed element is created and what are the tax implications for the spouse? So you can see here, if we look through the thing there, look at the third column, if the spouse elects to take a lump sum and exit superannuation, as this is the spouse and it is a death benefits are tax-free anyway. So even though there is an untaxed element, perhaps I should go back to the first column first, sorry, I'm trying to wind up here. On that ATO formula, based on those numbers, an untaxed element of $881,000 is created. So we now go back to, if the spouse just simply takes that benefit as a lump sum and exit super, as a death benefit to the spouse, it's all tax-free. There's still an untaxed element there, but it becomes irrelevant. No danger, no harm, no foul. If the spouse begins an income stream, death benefit income stream from the same fund, there's been no lump sum created. So while there may be an untaxed element, it's irrelevant. But if the spouse rolls over to begin a pension with another fund, be that because she wants to unwind the self-managed super fund, or whether the advisor says, no, there's a much better fund here, that $881,000 is taxed at 15% and creates a tax bill of $132,000. And that is as relevant to somebody who has a death benefit that was taken 10 years ago as it is somebody who died in 2018. So there's some real dangers and some real red flags should be raised when you're dealing with your death benefits. And again, if you're unsure of it, you need to get advice. Point here really is that you're less likely to get this problem if you're dealing in retail funds than if you're dealing with self-managed super funds, because these are really new rules which have come out. We have no idea really how the tax office is going to deal with with some of these sort of situations where they get it wrong. Hopefully they're still in education mode, but no, there are some real dangers here which need to be that you need to be aware of. New regulatory and reporting responsibilities. I'm not going to spend an awful lot of time on this one because facts are facts. This is an old chestnut. Everybody says, oh, do you really want to be bothered? How long does it take to manage a self-managed super fund and all those sort of things? So it is an old one. But, you know, there are some general rules. There are some trends which you should be taking account of. You do need to remember that trustee, as trustees, we all have faith in our accountants and in our administrators. But the facts are that there is increasing regulation. We are going to be moving more and more to real-time reporting, which can be a real problem for self-managed super funds, and that no matter how much you trust your accountant or your administrator, as trustee, you're the one on the hook. You are the one responsible. Join your accountant, join your administrator in an action. Still going to be expensive, still going to be very, very time consuming, still best to avoid the situation if you can. Flexibility brings complexity. I often liken this to the difference between having a driving license and having a boating license. I know it sounds odd. You have a car license, you know which side of the road to drive, you know traffic lights, you know all those sort of things. You get a boat, you do a course for 2 hours, never driven a boat before, you launch it, you're at the launching ramp. Suddenly you've got green, you've got red, which side goes where? Which side do I pass? You get out past the 5-knot zone, I can go anywhere. I can do anything I like. I'm not limited to just staying on the road. Oh, what's that marker over there that's got 2 black triangles facing down? What's that bloke mean over there where he's got a flag, blue flag with a white slash through it? They are all guidelines as to how you can act and what you can do. But as long as you be aware of those, you can do anything you like. Self-managed super funds are very much like that. Your retail funds are like the car. They have lots of rules, lots of processes in place. Your self-managed super fund, you've got guiding lights, you've got rules, Tax Act, Super Act, Super Regs, all those sort of things. And as long as you're aware of those, you can do an awful lot of things, a lot of flexibility. But with that brings complexity. And with that, you're getting, all our reporting is getting more complex. Our larger self-managed super funds are having to move to real-time reporting. By larger, I mean really anything with more than $1 million in certain circumstances. Platforms do this real-time reporting automatically. Self-managed super funds rarely do it. Self-managed super fund trustees rely on our administrators and accountants to meet the responsibilities, but we cannot give it away. Some of the new ones that we're looking at here are the so-called T-bar or the event-based reporting. You can see there are certain things which we now have to report. The interesting one is the next bullet point, self-managed super funds transfer balance account reporting deadlines. So where a member has a total super balance, so that's pensions plus accumulations plus rollovers in transit, all those sort of things, of $1 million or more at the 30th of 6th of the previous financial year. So it's something you have to look at every year. And the first member commences their first retirement phase income stream, then you've got to report it all within 28 days at the end of the quarter the event occurred. So again, in a self-managed super fund, you know, you've got to be aware of these things. And if you go ahead and do this, because you can, make sure your accountant knows about it. Probably means the accountant's going to have to bring the accounts up to date in order to do all the reporting, all of those sort of things. None of those problems arise again when you've got the platform, because all of it is done in real time, and the platform does all of those things for you. So again, You can do it, but you need to be aware of it. Your self-managed super funds are probably a greater risk than is somebody on a platform. Okay, I'm going to go through these slides a little bit more quickly here. This is really trying to do a comparison between the wrap and the self-managed super funds, and I've broken it down to certain areas. So the first one here is about performance. As you can see, we've got investment choices, investment strategy and flexibility, accurate and timely reporting, immediate tax effect benefits and things like this. So I'll leave you to go through most of these because you're probably aware of what I'm going to say. Again, unless you're dealing with real property or limited recourse bond arrangements or collectibles or illiquids, there's not a lot of benefit to the self-managed super fund. Your strategies, your flexibility, again, for a vast majority of us, your platform will cater to it. The interesting one is the immediate tax effect benefits. And again, this is not always open with all platforms, but certainly it is with NetWealth. We all know that with your franking credits, you get a $70 dividend, you've got a $30 franking credit. Certainly on the NetWealth platform, I'm sure there'll be others around that do it. You get that $30 immediately. You've got that $30 cash immediately at the time of the franking credit to go and invest. Not so with your self-managed super fund. You have to wait for your tax return to claim the franking credit expenses or the losses or whatever it happens to be. And this flows right through to the dollar, the tax benefit of expense deductibility and the tax impact benefit of realising losses. All of these are passed through immediately, certainly on the NetWealth platform, so I'm sure they are on other platforms as well, whereas you do have to wait. The big one with self-managed super funds, of course, is that you defer the 15% contributions tax until you put your tax return in, and that could be anything up to sort of 14, 16 months after the date you put the contribution in, so you have that there to use. That's true, but only true of accumulation. And if you go back to a general proposition, which is the lifecycle of self-managed super funds, yeah, by all means at that time, that's a really good benefit of them. But as you move towards the retirement phase, that's no longer such an important benefit. In fact, it probably doesn't really matter all that much at all. Look here at costs, and again, I think this, again, just trying to give a bit of a background and something to allow you to make proper decisions. So our legal costs, you know, once-off, set-offs, trustees, your corporate trustees, you don't have any of that in a super app. Yes, you do in a self-managed super fund. And the numbers that I've got up here, expectation versus actual and estimated in the legal setup costs, is from ASIC's report, Self-Managed Super Funds Improving the Quality of Advice and Member Expectations, June 2018. So that's reasonably current. And the numbers here show that the expectation was that it should cost about $1,000 to set up a self-managed super fund, your deeds and things. The actual estimated is somewhere between $916 and $2,035. The difference there obviously is, you know, buying an online deed versus going to a proper law firm and getting a high quality deed. You're joining your establishment fees. Again, where we're dealing with direct clients, no, there's no joining fee, establishment fees and things like that for the direct clients. The advisors have a choice how much they want to join. Okay, how much they want to charge. Obviously, if you use an accountant, no, you don't. I guess we probably do need to clarify that joining and initial establishment fees, we're talking there really about the advisor fees. Any wrap is going to have a fee structure which is usually based on a tier system and a percentage base. In NetWealth's case, for example, that runs out to zero at about the $1 million mark. So we're really talking here, trying to make sure that you're comparing apples with apples. Our ongoing super fees, yes, the wrap normally has an annual administration fee. It can be percentage based, it's tier based, all of those sort of things. It depends on your self-managed super fund. It varies by provider and by the service required. The expectation was that it should cost about $680. The actual is somewhere between nearly $3,600 and $4,174. Again, those numbers are from ASIC. I'm sure you'll be looking at those saying it doesn't cost me anywhere near that. That's just not a realistic number. I'm not sure. It's the figure reported by ASIC on their research. Certainly, I know my figures are closer to that 3.5 mark than they are the 4 mark. But it depends again on what you're getting the administrator to do. whether the administrator is limiting to you to just one cash account and only limited number of transactions and all those sort of things, or whether it's a full service or those issues. Supervisory levy, no on the super wrap, yes on the self-managed super fund. Ongoing admin fees, no if you do it entirely yourself. We're talking about the investment fees. Yes, if you have an advisor involved, they'll charge for the strategic investment decisions. Again, if you've got an accounting firm doing it or an admin group doing it, no. If you do it all yourself totally, you're not going to have any of these fees to pay. But if you're using an advisor or an accountant, then they're usually going to charge something for the advice, maybe a non-super wrap fee. It depends. Real point here is costs are changing, wraps are coming down, they're becoming much more competitive. Where the responsibility rests. Won't go through this too much. You can see obviously the super wrap has far less in terms of responsibilities because you are not the trustee. I think the two key ones here are the penalty regimes, which are specifically aimed at trustees. We don't have any penalty regimes under a super wrap or super platform type scenario. Yes, you do with a self-managed super fund. These are the latest ones. The small ones, failure to prepare financial statements, $2,100 per trustee. So if you've got 4 trustees, multiply that number by 4. If you've got 2 trustees, multiply it by 2. The highest ones are $12,600 per trustee. I've heard of some horrendous fines. Do they often get charged? No. The ATO has still been in education mode, and they will often reduce the fines, but they will often then put in education directives or rectification directives. How long are they going to be in education mode? Not sure on the answer to that question. Certainly they're getting tougher. Certainly they have the ability to throw the book at you in terms of those fees if they choose to do so, or if the breaches are strict enough. And they're keeping a record of them now. So they might give you a pass the first time, but the second and third times you can expect those fines to be applied. Another big one that we see is issues for moving and working overseas. Massive penalties if you breach the rules on a self-managed super fund. You can lose up to half of the value of your fund, not the earnings, half the value of your fund. Self-managed super, a retail wrap, no problems at all. You want to contribute as a non-tax resident while you're working overseas, even as a tax resident while you're working overseas, no problems. You want to manage your investments, no problems. Is there a penalty for breaching? No, there's no breach. If you've got a self-managed super fund, be aware of the active member test, be aware of the central management and control test, and there's a massive penalty involved. Again, those rules changed relatively recently, probably in the last 5 or 6 years. People used to believe as long as I'm not away for more than, I think it was 2 years, I'm okay. Not true anymore. You could be subject to those rules from the day you leave the country. Under other circumstances, you might get away with 2.5 years. Depends on your circumstances. Depends, for example, whether you've sold your home, closed your bank accounts and moved offshore permanently, or whether you've left it all here because you think you're returning. Those sort of grey areas, you need to be aware of them. Complaints and resolution process, yes, you have all access to all of those with the super app, with the platform. Plus, you also have protection against fraud under the government scheme, as we saw a number of years ago. None of that's available under your self-managed super fund. Really, if you want to question it, you've got a problem, you go to the court system, and as you can imagine, that gets very expensive indeed. Dealing with the trifecta: aging, dementia, and death. Oh, aging. Do you really want all the management administration responsibilities? In the wrap, don't have to worry about it. It's just no issue because we do it all for you. Self-managed super fund depends on the individuals, but there's no doubt that there's possible change in priorities, grandchildren, travelling, those sort of things, and there's no doubt there is some mental capacity, capability diminishing with age, which you need to take into account. Can you hand it over to somebody else? Yeah, look, in the super platform, a simple EPOA, a power of attorney, enduring power of attorney will allow the attorney to make the investment decisions for you, but the product provider is remaining the trustee and retains overall control. Possible in the self-managed super fund, but not all that simple. The enduring power of attorney must become the trustee, so you basically give away all the control and the full discretion to the third party. May not be a problem, but you need to be aware of it. Dealing with dementia and similar mental decline, not an issue really with any of the under the super platform, because you can put the EPOA into place, you can have it dealt with. How do you deal with the self-managed super fund? A lot of it depends on the rules of your fund. Is it affected by the fit and proper person rule? Well, yes, trustees must be able to perform their duties. Can you remain a trustee? Well, not really, because the trustees must be able to perform their duties. Not a rule that says you must resign and all that sort of stuff, but if you can't perform your duties, you can't remain a trustee. If the trustee doesn't have the enduring power of attorney, is not appointed in advance, how do you resign? Often the rules of the fund say that, trustee has to be voted out by a majority of the members. But if there's two members in the fund and one of them's got dementia, how do you get around that problem? If you've got a corporate trustee and minutes and things have got to be signed by, a director and a secretary, and you split that between the two partners, how do you deal with that? There are ways around these problems. It's not saying that you can't get around these problems, but it depends on the rules. It depends on putting processes in place first, and if you don't get it right, it can end up being very time-consuming and very expensive to come up with proper legal solutions to some of these issues. And again, in your super platform, these issues tend not to arise. So when you're looking at your life cycle, where are you in that life cycle table? These issues become important. Death and pensions, look, they're pretty even all the way through. Maybe the self-managed super fund has a little bit of a benefit here. I would question that. Both trustees, whether it be platform or the self-managed super fund, can have absolute discretion. Platforms tend to limit this by rules because, frankly, we don't want to get involved in a fight between the members of an estate. So we are simply going to say, look, these things don't work. We're paying it to the LPR. You sort it out in the estate. When you've got a self-managed super fund and you've got absolute discretion, it can become a real bun fight. And nothing breaks up a family more quickly than money. So again, be aware of these things. Final moves, divorce, estate planning, winding up, much the same sort of thing. Again, often easy in the super app. Go through, work it through, see where you fit on that one. Okay, now I read down to getting a wind-up sign. Okay, so estate planning disasters to avoid. What we're dealing with here is, again, this whole concept that flexibility provides complexity. Traditionally, all trustees have discretion as to how to have discretion on how to release deceased members' benefits and how they are dealt with. Super law has created additional law to allow members to bind trustees, being your binding death benefit nominations and similar, to be valid. You need very specific conditions. Retail super platforms, there's a true separation between your trustee responsibility and your beneficiary wishes. We have specific tailored documents and processes in place to minimise the risk of invalidity of the documents, not invalidity of health. We've replaced visible discretion with black and white rules. Self-managed super funds have a lack of separation between trustees and beneficiaries. Yes, legally they have different hats. Good luck on trying to enforce that. Deeds and documents that are often out of date. How long since your deed's been updated? I've come across deeds that haven't been updated in 30 years. Specific tailored documents are often lost, resulting in ad hoc replacement documents. Oh, Mr. Accountant, Mr. Administrator, I need a binding death benefit nomination form, please. Oh, it's not in the file. I'll grab one out of this file. Maybe different, leads to problems. As a result, the self-managed super funds are often at greater risk of legal challenge. They really are. To try and flesh this out, given the time, I'm not going to read through all of these, but I would encourage you all to have a read of these. This is a famous one, and as one of the legal eagles that we deal with says, he who controls the purse strings. So in this particular case, Francesca and Augusta, it was a second marriage. Mrs. Francesca Conti, she passed away in 2010. Binding death benefit nomination had lapsed, it was no longer valid. In the absence of a valid BDN, the fund's trustee allowed trustee discretion how to pay the death benefits. Surprise, surprise, Mr. Conti, the new husband, decided to pay it all to himself. Kids, Mrs. Conti's kids were not real happy with that. So they took legal action, firstly saying that the trustee required the appointment of the deceased LPR as trustee. Secondly, that the decision was in bad faith. You can see from the result, the court rejected both claims. You don't have to appoint the LPR, and it was up to the children to show bad faith. They couldn't show either, they missed out. Worcester versus Morris, again, if you haven't heard of it, you really do need to read this one. This particular case, second wife Patricia, she and Max were the only members of the self-managed super fund. He passed away in February 2010, having made a binding death benefit nomination, 100% in favour of his two daughters. He made other arrangements for his second wife. The BDBN was fine, but she got legal advice saying it was ineffective. As a result of that, she created a corporate trustee, paid the whole lot to herself. Kids challenged it. This is the interesting part. Even though in the end it was held to be valid, the case went for over 3 years before a decision was made in November 2013. Patricia died in September 2013, so she died before the case was resolved. The court found the BDBN was valid, said, Patricia, you've got to pay all of those fees, all the costs and everything else. But guess what? She had died, her estate was bankrupt, there was nothing to recover. Give you some idea of the number. Unclear how much of the deceased balance was ultimately paid to the daughters. An account balance of approximately $924,000 was shown in the accounts in June 2010, $75,000 left in November 2013. So there you go. This one, McIntosh and McIntosh, again, they simply got the wording wrong. In this one, the mother, the child died in intestate. The mother applied to be the appointer, in other words, become the LPR, decided to pay the benefits to herself, was held to be a conflict of interest. She had to end up paying money out to an estranged husband. And this one, Munro versus Munro, solicitor decided to write his own binding death benefit nomination, got the wording wrong. It meant that his second wife was able to keep all the benefits and his daughters completely missed out. So again, even solicitors get it wrong. Order, timing, documentation, get it right. Very, very important. Last slide. So when is enough enough? So as I said, what I'll try to do here is give you a little bit of a step-by-step process or a checklist. If you're using sophisticated investment strategies, specialised investments, you have a really strong need, but as you move down that list, perhaps you should be thinking more about using a super platform. Financial planning, investment planning is about looking ahead. When you're using your self-managed super funds and you put this against the idea that a self-managed super fund has a use-by date, it becomes really important to understand what the concepts are, understand where the limitations are, and do a proper assessment and a logical assessment as to which structure is best for you. Okay, I'll leave it at that. Thank you very much.
Thank you, Nigel. Lots to cover there. I hope you all found it really insightful. I'll just go to one question that kept coming up from a few different people. Nigel, can people hold precious metals in retail funds or only in SMSFs?
I think the strict answer to that question is probably it depends on which retail fund. I think the practical answer to the question is only in a self-managed super fund. I think I cannot think of a single retail fund that has the ability to hold gold ingots or diamonds or something along those reasons. So my answer would be only in a self-managed super fund, albeit there's no law against a retail fund doing so. There's too many practical problems involved with it.
Awesome. Thank you again, Nigel. Thanks for everyone for joining us. I just want to go through a few points because I hope we answered all of your questions throughout. Just a reminder, we'll be sending the CPD point details within the week, as well as the recording and the slides so you can read through them. We also have a guide, Winding Up Your SMSF the Right Way guide, which is available on our website. We'll also send a link to it in the email. This will answer, I think, a lot of your questions as well, and it's been really useful to people so far. And we'll wrap up there. Thanks everyone for joining us today.